Investors who are long oil stocks might be watching the price of crude oil these days through their fingers. The price of West Texas Intermediate crude is down 24% since late September and has now posted 6 consecutive weekly declines. Canadian oil producers are still generating lots of cash flow, but their share prices have, not surprisingly, also come under pressure. For insight, let's go to Mike McGlone. He's senior commodity strategist at Bloomberg News. We're also joined by our featured guest of the morning, Lyle Stein of Forvest Global Wealth Management. Mike, great to have you. You, for a long time, have been calling for crude oil with a 6 handle, $60 plus crude oil. We are now down into the very low 70s. What do you think?
Yes, well, hello, Paul. I think it's very much not profound to expect to see around $40 a barrel probably next year, particularly if Bloomberg Economics is right about a U.S. recession, which I think they will. But you're on the back end of that big pump in prices because of Russia's invasion of Ukraine. That's really bad for prices, because what did it do? It accelerated those pre-existing trends of North America supply exceeding demand. U.S. and Canada right now is approaching 6 million barrels a day of excess. 2008 when crude oil peaked, there was definitely a deficit. And at the same time, now we're seeing increasing OPEC spare capacity. Why? Start cutting back supply to offset all this excess. It's the back end of a typical cycle. And now we have the issue with all the, it was just a few months ago, most central banks on the planet were still hiking. So the full effects of these hikes haven't even kicked in yet. Now, we've seen a strong U.S. payroll report that helped crude oil bounce, but I think crude oil's got a new ceiling around $80 a barrel, which was right about the high around 2018 before COVID and everything. And the lows since 2008 have been below or around 40. So to me, it's not unusual to expect that kind of level. Basically, you kind of need low levels to shut off this excess of supply versus demand. Okay, well, I want to briefly welcome our featured guest of the morning to the program. He's Lyle Stein at Forvest Global Wealth Management. Lyle, thanks a lot, as always, for joining us. You've got a question to Mike as well.
Yeah, Mike, you mentioned the fact that recession is built into sort of the Bloomberg economics forecast. Without recession, where do you see oil prices? And in that recession context, we talk about 100 million barrels. Where would demand go? Would it fall to 90, in the mid-90s? Where do you see that? Well, I think it's, Lyle, I'm glad you brought that in there, because if we don't get this recession, it's very unlikely the Fed's going to cut rates. And that's the key thing the market's been wrong about all year. Every single expectation in the beginning of the year is, oh, they're going to start cutting rates in 8 to 12 months. And they haven't done that. And now we just keep pushing that forward, backwards. So I think we're not going to get that relief of lower rates, which should offset a recession and kick the economy in without without the recession. So that's the headwind. But the key thing from a U.S. standpoint, U.S. and North America, is crude oil demand peaked many years ago. And now unleaded gas, diesel demand, natural gas, container boards, all that demand is in recession already, and the rest of the world's picking up a little bit. But I look at OPEC's ability to cut supply to their main customers, China and Europe, as an indication that demand's not so great, and probably China's probably already refilled its SPR, Strategic Petroleum Reserve. So this tilt is, my key question is, we see that tilt towards lower prices. What stops it?
I don't want to let you go, Mike, before talking cryptocurrencies with you as well. Investors know, of course, that the Bitcoin has taken off. Now, is this part of that what you think is perhaps a naive expectation of investors that rates are getting cut? We've seen a lot of assets, stocks, tech stocks, high growth stocks, take off since late October. What is driving the Bitcoin rally? We're looking at Bitcoin now at $42,000 and change.
I think it's part of the same thing that's driving all risk assets to rally, Paul. And that's the beginning of the year. Remember, there's recession was supposed to come. Now, yes, it hasn't come. It's delayed, but we got more rates, and it was very cheap. But now we're at the point where most risk assets, including Bitcoin, are really high. Now, I put that in the group because I look at Bitcoin as the most significant leading indicator on a 24/7 basis for risk assets. It's up a lot this year, but look at next year. What's that bent? It's already up. Stock market's already up, and it's at very good resistance in terms of Bitcoin. The key thing is everybody's expecting this Bitcoin ETF's going to make a difference. I don't think that's going to really think a lot of flows into Bitcoin until people have a reason not to do what's been doing great for them for at least the last decade, is being the stock market. U.S. stock market's so resilient. Why invest in gold and Bitcoin? So to me, that's the tilt that's going to happen, and Bitcoin's already bounced a lot. But one thing it does have going for it, compared to other commodities, is diminishing supply. Prices do not bring on the supply, only more selling. It doesn't bring on organic supply like it does in crude oil and grain, corn, and copper.